So welcome back to our video series. As you remember, last year in 2015, we did a mid-year review where I talked about some slides. And here we are in January of 2016. We're going to go ahead and recap some of those slides and talk about some things for 2016. So first I want to start, let's recap how the U.S. economy has done since our last video. We started off talking about how the recovery still has room to run. First, we looked at housing and cars, which we believe are two huge components to a recovery and equally important to any economic expansion. Since our last video, the number of new homes built increased from 1 million to over 1.1 million, and the number of new cars sold also increased from 17 million to 18 million. So remember, no one buys a new car when they worry about their job, their income, or their financial status. So both of these sectors are still signaling to us that we're not at the end of an economic expansion. Then we looked at the individual consumer, because consumer spending makes up nearly 2/3 of GDP. Household net worth grew from the second quarter to the fourth quarter, supported by rising home prices and financial assets. The percentage of money that individuals spend on their mortgage stayed where it was since our last video. Household debt service ratios remain near 35-year lows, so overall, the U.S. consumer's financial position has slightly improved. Again, this is supportive of our belief that we are not heading into a recession. In terms of long-term drivers of economic growth, our outlook for the U.S. is unchanged. Growth in the long run may be constrained by retiring baby boomers and a lack of capital spending, but American companies are innovative and should find ways to generate shareholder value. We still believe that stocks offer considerable value. As a reminder, this chart shows the forward PE ratio of the S&P 500 over the past 25 years, which is a way to see how cheap or expensive stocks look. During our last video, the PE ratio was at 16.6 times forward earnings. Now that number has fallen down to 16.1 times forward earnings, which means stocks are still a little more expensive than the historical average of 15.8, but not overly expensive. All of this is to say that with equity valuations hovering around their long-term averages, stocks still stand to benefit from a growing economy. Now let's reiterate why we don't think a bear market is on the horizon. This slide shows the 10 previous corrections going back to 1926. All but 2 of those corrections coincided with an economic recession, and every one of those was associated with either aggressive interest rate hikes, a spike in commodity prices, extreme valuations, or some combination of those 3 things. Basically, history says it's unusual for the stock market to experience a decline of 20% or more without there being one of those other factors. And right now, none of those other conditions exists. There is certainly no commodity spike or extreme valuations as we outlined in the last slide on forward PE ratios. Also, we recently saw our first interest rate hike since 2007, which wasn't very aggressive. Okay, why do we think a recession isn't around the corner? Well, you've probably read in some of our blogs that we look at overspending, overborrowing, and overconfidence. Burt White, who's the Chief Investment Officer for LPL Financial and a good friend, created what he calls the over-index. Now, the over-index measures trends in 3 broad economic drivers: borrowing, confidence, and spending. He then identified 4 subcomponents that best showcase the characteristics of each of those 3 drivers. The over-index takes each of those subcomponents and uses a statistical process to normalize and index each one of the data series into an overall score for each of the 3 drivers. Here's what Burt's team came up with. First, here are the 3 sub-indices. While overconfidence has had the steepest increase, none are very high relative to history. Now here's the actual over-index that blends all 3 sub-indices together, superimposed over the historical recessions. You can see the blue and green dots representing 3 years prior and 1 year prior to the actual start of a recession, as well as the associated score of the index at that time. They're pretty high. Notice where we are today. It's not a perfect science, but by looking at where we are now, it's a long way off from levels seen leading up to previous recessions. Okay, we've recently experienced one of the worst starts to a calendar year in history, with the S&P 500 down almost 6% as of January 11th, and almost 10% from its high set back in May of 2015. It can be argued that we're actually in correction territory. Additionally, the average stock in the S&P 500 is already off over 22% from their highs. So most individual securities already feel and look like a bear market. So with that in mind, I just want to point out a few slides to give everyone some perspective. So pullbacks happen. Let's take a look at this slide right here that shows some major pullbacks during the current market cycle on top. It's just a function of the way markets work. As you look back over time from 2010, 11, 12, 13, 14, 15, you'll see that there are blips in the market where there are some pullbacks. And there's some associated news with each one of those, but in the grand scheme of things, you can see that they are kind of insignificant to a long-term investor. So what this slide shows is the full year price return of the S&P 500 going all the way back to 1980, represented by the bars, and the biggest peak to trough return in that same year represented by those red dots. Since nothing in life moves in a straight line, the red dots are inevitable for each year, as there's always some give back off of the S&P 500 high each year. You can see here that the average inter-year drop is around 14.2%. The result? Well, 27 of the past 35 years, or close to 80% of the time, the market has a positive return for the calendar year. So history is on the side of those investors who do not overreact. To summarize, just because we've been in a bull market since 2009 doesn't mean it's just time for it to end. The U.S. economy still looks set to continue expanding. So while a bear market doesn't seem obvious to us today, that doesn't mean to say it's not going to happen in the future, but right now it's just not obvious. It's not a bad idea for investors to maintain a diversified portfolio to help protect against an unforeseen pullback or any sort of correction. Okay, thanks everyone for tuning in for the 2016 Economic Review. We'd love to hear your thoughts on the video and the economy, so please reach out to us by email or phone. Also, make sure you're subscribed to our weekly Off the Wall blog and other market commentary, which is found on our website.